Good morning and good afternoon, everyone. It's Ted Bader here with SIA Wealth, and thank you again for joining us for our weekly webinar. Today, we're going to have Jeremy talk a bit about the market outlook. I know we've been in the green zone now for almost a month, and these weekly webinars have been very well received, and a lot of feedback has been kind of coming to us about continuing these. But I think over the next few months, we'll try to do one every couple weeks, and we'll also try to incorporate some business building ideas into them. So we will do one next week, and then we're probably going to jump to one every 2 weeks after that. And we think it's a good opportunity to talk a bit about business building. We're having a lot of conversations with advisors about how to utilize, how to attract assets, and how to talk to clients about managing risk using SIA as kind of a system. And we think that'd be very beneficial going out there across the advisors. So we're going to talk a bit about that over the next little while. Today, Jeremy, we kind of handed off some control to Colin the last couple of weeks, and Jeremy's back today talking a bit more about the kind of broader economic picture and what we're seeing in the charts. First off, I wanted to also address a couple questions that we do get a lot. Jeremy, you want to flip in a couple slides? So here is our equity action call. I'm talking, the two funds I'm going to focus on right now are our pure equity funds. So we have our North American equity fund, and the next one I'm going to talk about in a second is our global equity fund. What I wanted to highlight is I like this chart because it kind of shows the green, the yellow, and the red zone over this year, 2020. And it shows you kind of what we're talking about when we say we're managing risk. Yes, there's a lot of people who can say, well, your system got signaled to get out of the markets too late, and it signaled to get back into the markets too late. The point is, hindsight's 2020. And at the bottom of the market, March 23rd, the fund, our BMO equity fund, as you can see in the below chart, was about negative 10% compared to our benchmark, which is about negative 28%. So this is what we're talking about. And at that point, that low, most people would agree, it did not look opportunistic. So over on the right, we kind of said, here are some of the main points that we saw in the market about what happened after we went in the red zone. So the US Fed cuts rates to zero, launches $700 billion stimulus package as a result of oil collapse and COVID-19. That week that we were out of the market, the Dow Jones declined by 17.3%, which was the second worst week in history. For the Dow, St. Louis Fed estimates a 46% workforce is high risk, and Q2 unemployment could be 32%. The U.S. Fed provides additional $2.3 trillion in loans. The amount of stimulus was unprecedented, right? Net asset purchases for G7 central banks exceeded $1 trillion, which was 5 times the previous high in April 2009. So my point is, when we went into our red zone in March 12th, we did not know what was going to happen. So our system helped us prevent that risk. Now, things came back. The world printed money at an unprecedented rate, and everyone said, okay, blue skies are here, and we're going to ignore the reality of the COVID crisis, and the stock market's going to keep on going up. So we eventually participated and got back in, and as you can see, we're pretty much in some situations we're beating our benchmarks by marginal 1-2%. The point isn't that we want to always win in every situation. The point that we're trying to make is that we want to really try to reduce that risk as much as possible. And that's exactly what we did, because there were so many unknowns going into it that how do you prepare? How do you know what the central banks are going to do? How do you know what the Fed's going to do? So by being out of the market, we are protecting ourselves from the worst these types of situation, and eventually we're going to be participating back in. So we're not permanent bears either. And that's an important point, is if you take from point A to point B, January 1st to May 22nd, which is what this data is based on, you see that you could have just held and went down and came back up. But the reality is, over the last many bear markets, it does take a lot longer to get back up to normal. So what we're trying to do is saying, there are a lot of advisors out there who held onto positions on the way down and continue to hold them on the way up. What we're saying and where we fit is as a complement to a lot of those long-only fundamental managers, as we are that tactical manager that will get out of the way, because hindsight is 2020, and nobody knew from March 12th to March 23rd what the reality of this situation was going to be. So this is a nice snapshot of showing the risk management in action. The next slide is our global equity fund as well. Shows you also a similar mandate. Again, right now we are back even to our benchmarks. 2 months ago, we were dramatically outperforming our benchmarks. But again, the point is we want to make sure we manage that risk appropriately. And this is exactly what we're talking about. So feel free to have any questions. Like we always mention, if you do have questions regarding the funds, please type it into the question box and we'll answer them at the end. But without any further ado, I'm going to pass it over to Jeremy to give us a bit of a market outlook.
Thanks, Ted, and thanks everyone for taking the time today. I'm just going to add on there, when we hit those red zones, we're really just in a situation where the Feds and the central banks of the world have to rescue us. And sometimes they do and sometimes they don't. They've been very successful as of late, but if they don't get it, those numbers can get really ugly really fast. So market update today, not a tremendous amount of slides to show because not a heck of a lot is changing. Things are just moving up for the most part. But we'll go through those slides because I think there's some key resistance levels we're at. Be good commentary for you and your clients on everything that's happening right now. So the first level analysis, as always, is the equity action call. We're in the green zone. We can see it in the top right corner here. We've seen a little bit of a dip in the green zone happened here on some of the pullback and the different relationships between risky and non-risky assets, between those equities and the equity alternatives. But we still remain in the green. So for now, we're continuing to be overweight equities to their maximum levels within our portfolios. The asset class rankings have not changed for a period of time here. International equity remains in first place, followed by cash. Still in an extraordinary situation to see cash in second place. Shows how much money is on the sidelines. For those who are bullish and believe in the green zone, this is cash that could or should be forced back into equities over time, but certainly sitting there on the sidelines being cautious still. But we still see money flow still moving to cash. U.S. equity is in third position. It is close to being into the second position there. Really very, very close on our indicators. We do not move ahead of them because we see that quite often, but I do get asked how close things are. It is close at this time, but we do not move ahead of it because quite often when we get to these levels, you can have those reversals. Currency in the fourth position, which is just, again, cash and currencies that are not U.S. and Canadian, remaining in the fourth position, again, highlighting how much cash, even with the loftier levels in the stock market on those cap-weighted indexes, we still see money on the sidelines. Canadian equity continues to lag both international and U.S. equity. It's been a very, very narrow market in Canada, and I have a chart on that to highlight that down the road. Commodities, weaker crude has come back. Gold is sort of softened up, but it just kind of stalled out here as this rally progressed, which would be expected. And then finally, bonds in seventh position, which again speaks to the situation we're in where bonds really were a larger catalyst for some of the equity weakness we saw as the bond market locked up during the crisis and managers were forced to sell equities to gain liquidity for their funds and for their assets. Bonds remain weak, and again, there's tremendous amounts of borrowing going on, refinancing going on, but net, there's a huge supply of bonds in the market these days. So debt and reallocation continue to drive markets higher. So again, this is really a bull market built largely on the backs of fiscal and monetary stimulus. We saw in February and March, the S&P 500 suffered the fastest bear market on record with a drop of 33% in less than a month. So extremely strong downturn. I mean, we don't have to remind anyone here how fast that happened and how quickly it happened. But that global monetary and fiscal measures in the tune of trillions of dollars has been implemented. So there's been massive amounts of money flows coming from all levels of government, certainly in Canada, provincial, federal, large pools coming there. in the United States. We're seeing state level and the federal level as well, and around the world. So this has largely been money, and a tremendous amount of it at the central bank level has been focused on supporting debt markets, supporting equity markets, again, really stretching the limits of what their mandates are, but certainly creating some tremendous support. And at this time, as we've spoken up before, as long as this COVID-19 situation is around, they've pretty much got a largely a blank check. There's not a lot of oversight today. We can see in Canada, Parliament was postponed until September, so the printing presses will continue without any opposition at all. So I think that should give us some upside potential in the markets. One of the other sides of it too is that governments are not as fearful of debt because now their borrowing costs have dropped tremendously, as we've seen with interest rates dropping. The Federal Reserve and central banks, Bank of Canada, have dropped interest rates to unprecedented lows. That gives governments a great opportunity to borrow more money and have their debt servicing lower. The principal side, I guess we'll figure that out in our later years, or our children or grandchildren will. But as it sits today, there's tremendous amounts of money coming in. The other part of it is the rotation out of bonds and real estate. We're certainly seeing real estate show quite a bit weaker on a relative strength basis. Bonds, as we just highlighted a couple minutes ago, sitting in the 7th position of our asset class rankings. Those managers who are laden with bonds and laden with real estate really are being driven to look for higher returns, and equities is really the place that appears to be getting the brunt of that benefit. So some of the pros that are happening right now, the economies are reopening. So there, as we saw earlier this week and last week, a lot of activity in the stock market as economies get back underway. We've seen some potential vaccines are in the works with tests underway. So these are happening in a number of places. There's pent-up demands potentially for goods and services. These could see a surge in sales as people reintroduce themselves to the economy and maybe purchase those items or go visit those stores that they couldn't get online while they were in self-isolation. And then finally, new COVID-19 cases are declining. We can see in the chart on the right here that it has been declining. It's a 5-day moving average, so it's been declining based on the 10 most affected countries. So this is relatively good news that's sitting out there. So the risks of the economy reopening, second waves are all but expected, and they're certainly not uncommon with pandemics. We can see history shows us that, pandemics generally have a second wave. We're going to see continued businesses are failing. So even as they move into reopening, they sit in a situation where there's now, in most cases, additional costs. Any of us, even in our office, we're having to take measures and spend money on ways to get reopened. But if you're a retail store with a lot of traffic, those costs and measures can be quite extensive. And some businesses are choosing, as we've seen in the news lately, just not to reopen. And then there's people just not taking appropriate measures. There's a picture down below. This is highlighting activities in Toronto. And if you watch the news, you're certainly seeing lots of this. So that second possible outbreak, and there's a couple of possible scenarios that I was reading on that I highlighted here. So we're in the first hump. Potentially the second level could be even higher than the first as we get back here. And even in the best case scenario, they expect it to be almost as big as it has been previously. So we've got these uncertainties. No one knows what levels these are going to be. So obviously the markets are going to be paying very, very close attention to what's happening with the COVID situation, as well as potentially significant businesses that will no longer return to operation. The first chart I want to look at today is the SIA charts Market Equal Weight Index. This is our broadest based measure of equities. We've got Canadian, US, and international equities all combined in here on an equal weight basis. We're looking at the chart right now. We've had really a very dramatic increase in the value of this benchmark for us. It's retraced 80% of the drop in February, March, and we spoke, back a month and change ago about what was happening. We were we were more concerned previous to the green zone that we were not seeing a broad rally. What this chart is highlighting is that the breadth in the market has widened out, possibly with the exception of Canada, but internationally in the U.S., certainly the breadth has widened out, and that's why we see this as growing aggressively. We're sitting at resistance, so this is key. A pullback is certainly not out of the question where we're at here. I don't think we should panic on a pullback. We've got an extremely overbought on a short-term basis chart with, and we've had tremendous monetary and fiscal stimulus. So there's been a lot of good news priced into the market. A retracement from here is not to be unexpected. Certainly, the biggest leader that we've seen on the cap-weighted indexes has been the NASDAQ Composite. It's retraced 85% of its drop. It's, 11 out of 13 boxes have come back onto this chart after that drop in February, March. So that's just absolutely incredible. It's moving. Its next test is really, resistance at its highs back in February, and it has not seen one column of O's in its ascent. So again, not dissimilar to what we would see on our market equal weight index. A pullback is not out of the question here. Could be healthy for the market, based on what's happening. So if there's no tremendously bad news, a pullback would still be in the context of a bullish pattern that has emerged given the fiscal and monetary stimulus and the reinvigorated attraction of equities based on real estate and bonds, maybe less attractive situation. The S&P 500 is a little bit different. It's only retraced about 75% of its drop, so not as focused on some of those technology names that have really led the charge in the United States and done very well, the Amazons of the world, Netflix, etc. It did move through resistance, though, recently at 2953, so has moved. The next test is, in that 3100 and change range, so we're watching to see if that comes to fruition. But again, a pullback, even at these levels, we're not sitting right at resistance, but we've had a tremendous rally coming off. We, again, sits in that level where a retracement would not be unhealthy for this chart as we move forward. In Canada, the S&P TSX Composite Index, I was just looking, and it could go back further, but the most recent chart that I annotated on this was May 5th. We're sitting at May 26th, so we've got 3 weeks of additional data. The chart hasn't changed at all, so it hasn't moved up where we've seen movement internationally, where we've seen movement upward in the U.S. indexes. We have not in Canada. So remains a very narrow rally, with Shopify and precious metals really leading the charge here. So I think that's important to note, and we really see that within the charts on here, and we see it in its position in the asset class ranking. So really a great situation to start looking at our focused Canadian equity ETF fund, it's done tremendously well. We're able to focus on that narrow support within the Canadian marketplace, and we've seen good performance on that portfolio. So again, if you haven't got that position, take a look at ZFC. It's done very well, and its mutual fund counterparts. Looking at the chart, resistance is below 15,766, so sitting above, even though it has not participated in the rally over the last month to the degree that other indexes have. A pullback is certainly not out of the question, so we'd be watching for that on the Canadian market as well. On the international side, I wanted to highlight an area of strength that we've been noticing, and that's in the Europe markets. International remains the number one asset class, so traditionally investment advisors and individuals within the Canadian marketplace tend not to have as much international exposure as maybe they should have. I think this is a chart that highlights that you should take another look at it. Certainly, we have access through our global equity, global asset allocation products at SA Wealth. Europe has moved up strongly. It's sitting at resistance here, so a pullback would be healthy at this point and potentially give you opportunities to make some purchases. So we're watching this chart very closely as well. I believe this is the last chart I have for today, and that's copper. I like to watch this. It's seen broadly and and I've been in this business long enough that it's seen, where this is a barometer for global growth. It has reversed up. We saw lows of 212. The short-term SMAX continues to be very, very stubborn on this chart, so that's a bit concerning from my point of view, but we have seen a retracement up about 50% of what we saw from the highs of 2020. So that's good to see. A pullback here, again, wouldn't be terrifying at this moment in time, but really watching for that 249 level. Love to see that get taken out. Love to see us testing that 274 level over the next few weeks and months. Would be great to see as additional support for a bullish sentiment in equities. So with that, I think we'll just open everything up to questions. Ted, have you got any questions that have come up over the presentation?
Yep, I have. So here's a couple questions. One was, can you touch on the tech sector and precious metals? And are we seeing something of a sector rotation given the weakness that we've seen in that recently?
Yeah, great question. Certainly over the last couple of days, both of those sectors have seen rotation out. We're in that overbought situation. My concern would be is to not abandon those positions entirely if you're looking at rotating out of them, because traditionally the leaders that come out of crises tend to continue to be leaders for a period of time. So the relative strength still remains good. We are not concerned at this time that this is something that's going to turn into a material change, but it's actually quite healthy for the market to see this rotation, a sell-off there, seeing other stocks getting some participation. But again, for this bull market to continue, it's that cash on the sidelines that needs to come in. So short term, we're not concerned. It would be an area where we will update if we see that relative strength totally eat away, but at least over just a couple of days, we would look at this as short-term profit-taking, trading, probably a ton of computer models that are being executed, algorithms being executed against those positions as their overbought level was quite high.
Okay, and then one, there's still a lot of uncertainty in the world. There's still a lot of people thinking there's another leg down. However, the timing of that leg down is what the big question is. What's your recommendation for some of my clients who have money sitting in cash right now? Stay there, start to get back in the market?
At a minimum, you need to start to get some money back to work here. We are resistant, so pullbacks here would be advantageous to take advantage of. There's a lot of things going for a bullish sentiment in green equity action call. So, if the COVID numbers spiked extremely materially, if there was bad news potentially on some of the potential vaccines that are out there, but you have to step back and realize that central banks and governments still have all the tools and they haven't used up all their ammo and continue to be extremely supportive of the marketplace. So we should expect that. We talked a little bit on a couple or a few webinars ago about the election coming up in the US and the impetus obviously by the incumbent to maintain strong stock market values going into that election and everything they can throw at it. So there's still a lot of tools at play. The concerns are there, and we know we deal with this daily. When we went back into the market a month ago, there was a tremendous amount of our clients were still very, very concerned. We've seen the rally come since, so they've missed that, and now you feel even more hesitant. But you need to have some of that equity in. If you're concerned, just lump it in slowly over a period of time, but there's opportunities still available in the market from our observations.
Okay. Great. So that looks like it for the questions. We'll wrap it up. One quick comment. Next week is the end of the month, so we will be pushing out all of our monthly commentary about what's happened so far in May out there. So that's all going to be relevant and timely. And as usual, if there's any questions, feel free to reach out to us. But we'll keep it nice and tight this week, and looking forward to talking to everyone next week.
Yeah, thanks everyone, and as always, reach out to us with any questions, comments, email, phone. We're here to support, and certainly look forward to working with you through what is continues to be a very confusing market at best. But we do have our tools. We do have observations that can give us confidence. So let's work with those. Thank you.